Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes.
Hello, I'm Sharon Haward-Laird, and I'm the head of Canadian Commercial Banking and North American Integrated Solutions and co-head of Canadian Personal and Commercial Banking at BMO Financial Group. Change and adaptation are not new in the business world. They are a normal part of operating in competitive markets. However, the level of change that we've currently seen across the US-Canadian border is notable. The two partners have a trading relationship that goes back more than 150 years, but they are seeing a real-time shift in priorities that has implications for businesses and investors in both markets. In this episode of Markets Plus, I'm joined by Doug Porter, Managing Director and Chief Economist here at BMO Financial Group. We'll be discussing a new research report from the BMO Economics team that explores potential scenarios for the US-Canada economic relationship and opportunities for progress. Welcome, Doug, and thanks for joining me today.
Well, thanks for having me, Sharon. It's a pleasure to be here.
Great. Well, let's jump right in. I want to ask you to start by describing the current state of affairs. Since President Donald Trump announced widespread tariffs on April 2nd, what have you seen happening in the US-Canada trade corridor?
So we could probably spend the entire length of the podcast going over the brief history of the many ups and downs and twists and turns of the trade relationship this year. But I think if we really distill it down to the current environment, I would echo the comments of the Prime Minister that Canada probably is in the most favorable or the least awkward situation now when it comes to tariffs with the US. That's not to say it's an ideal situation by any means, but the average tariff rate on Canada imposed by the US is somewhere to be between 6 to 7%. For the US as a whole, on all of its trading partners, it's a little bit more than 18%. So that is a relative advantage. But I will say the industries that are being affected by tariffs in Canada are being heavily affected. And I think that's really the important point to stress here is that while the impact is, not as serious or as intense as many of us expected or believed earlier this year, it is very concentrated. And just briefly to recap, we've essentially got a 50% tariff on both steel and aluminum, a very high tariff on lumber now when all the different components of it are combined. Now, lumber has always faced a tariff, but it's been ratcheted up again this year. And it depends which particular company you're talking about. But on average, we calculate the tariff rate on lumber is now almost 40%. On autos, the headline rate is 25%, but that's only on the non-US content. Our calculation is that the average vehicle crossing the border is being faced with about a 12% tariff, which is very serious stuff. And then also a specific sectoral tariff on copper. Again, that's a fairly narrow set of industries, important industries, and really a serious level of tariffs. But for most of the rest of the economy, at this point, as long as you're USMCA compliant, you're really not been that heavily affected by this new tariff regime. And relative to the rest of the world, it's not quite as serious. So I think the conventional wisdom around the spring was that Canada was going to go through at least a mild downturn as a result of all the economic and trade-related uncertainty. We did have one negative quarter, but from our perspective, we do think that the Canadian economy is likely to avoid a full-blown recession this year. It's been a struggle. We'll be, fortunate to see growth of just a little bit more than 1% is our view. But again, it's not quite as heavy a hit on the economy as we were expecting back in, say, March and April.
And Doug, you talked about the fact that certain industries were really hard hit. Are there certain geographies within Canada that are more impacted than others?
That's certainly the case. And that's what makes policymaking, especially monetary policymaking, very complicated at this juncture because the regions are being affected quite heavily. There's really no debate that Ontario, first and foremost, and to a lesser extent, Quebec, are being hit the most. And there are two reasons for that. First of all, those industries that I pointed out that are, where we're seeing the effect concentrated are mostly in Ontario and Quebec. And, as a natural matter of course, the Ontario and Quebec economies are more tied in to the US than most others. If I had to rank a third area that's been hardest hit, it would be BC. BC actually has probably the least exposure to the US economy among the 10 provinces, but their lumber sector is being, of course, very heavily affected by the tariffs. Other than that, I would actually say the prairies are in a fairly good position. Alberta's a large portion of their economy is exported to the US, but of course, most of it is energy, and energy has largely escaped any effect. And I would say Atlantic Canada would probably be next in line in terms of being least affected, but there are very wide regional differences. And again, that's what makes it very difficult for policymakers when they try to address the pain of the trade uncertainty.
So one of the things we hear a lot from our clients in Canadian commercial banking is, the fact that so many goods are exempt under the USMCA, and that is meaning that the impacts are significant to some industries, but not widespread. But now, no later than July 2026, which used to feel far away, but now is less than 12 months from now, negotiations to renew that agreement are supposed to begin. What do you think is at stake in those discussions for companies that do business in Canada and the US?
Well, some would argue that when you think back of what's happened over the last 6 months or so, there have been some questioning, well, what's really the meaning of the USMCA if the US administration can apply, almost willy-nilly tariffs on different industries, and potentially as much as a 25 or 35% tariff on all Canadian exports. But I would say the fact that the vast majority of exports to the US have been exempted because they are USMCA compliant shows you just how important the deal is. And in some respects, the structure of the tariffs we've seen on Canada really do raise the stakes. In what would have been an incredibly important review in any event, it makes it, that much more important. I don't want to overstate it, but it really is crucial that we, for most businesses, that we do arrive at some kind of a deal and have some sort of clarity and certainty, even if it's not an ideal world. Arguably the worst thing in the last 6 months has been the uncertainty and not so much the tariffs. And that's what we've heard from, many of our counterparts in other countries. And, how quickly places like the European Union and Japan agreed to something like a 15% blanket tariff. It showed that ultimately they were willing to accept a fairly high tariff just for, the certainty that it delivered. One could argue that it's the uncertainty that's actually the bigger weight on your economy than a baseline tariff of 10 to 15%.
Turning to the report that the BMO economics team put out, I really enjoyed the way you used three different scenarios because it does allow businesses to think about all, maybe not all, but a wide range of scenarios that could play out. And you organize those from benign to increasingly challenging. Could you, at a high level, walk us through those scenarios and how you would see those unfolding?
Yeah, certainly. And very briefly, the reason why we did it this way is we're trying to book in possibilities of almost from least bad to worst. We're not trying to pretend that these are the only three possibilities, but we see these as sort of being in the three midpoints of realistic outcomes. So the first, and I would have to say is probably the most likely scenario, is what we call muddle through. And that's essentially pretty close to where we are today. So some baseline tariffs do stick. There are some sectoral tariffs that won't necessarily stay exactly at current levels, but I think we know that the president is very serious about applying tariffs and protecting the industries of, say, steel, aluminum, and the auto sector. Again, we don't know that Canada is necessarily going to be subjected to these exact tariffs in the future, but we're essentially assuming an average U.S. tariff of pretty close to where we are today. And in that world, we think that ultimately that does clip Canadian output by about 1.5%, and it would add to the Canadian price level by about 1%. Not an ideal world, but manageable, and to a large extent, the economy's already absorbed a lot of that. Our view is that that's the most likely outcome, but by no means a done deal. In fact, we wouldn't even rate it as a 50% probability. I'd probably give it about a 40% probability. The next is what we call no special treatment. And essentially, this would lump Canada into a very similar world as what we've seen for Japan and the European Union. And that would be a blanket tariff of something like, perhaps somewhere between what the UK got, 10%, and what Europe and Japan got, and that's 15%. And, because there will also be the sectoral tariffs as well, we've assumed an average US tariff rate on Canada of about 15%, or about double of what we're dealing with today. I think that's probably the second most likely outcome. That would be a less positive reality for the economy. We think it would lead to a somewhat deeper cut to growth. We assume that GDP ultimately would be about 2.5% below tariff levels, and it would add about 1.5% to the Canadian price level. So a little bit more of a serious hit. And then there's the third realistic possibility. I think it is the least probable, but not impossible, and that's what we call continental divide. And this is essentially where the USMCA gets ripped up, that the president decides that Canada and Mexico just will not bend on a number of fairly important areas, and everyone walks away from the table. I think I would give that one about a 10 to 15% probability. Not very likely, but we certainly can't rule it out, because I do think some of the demands of the administration might just be in the range that the Canadian government could not agree to, and we do get a real rupture. I would like to believe that is the least likely of the three, but I think in that world, we would be looking at a Canadian recession. In fact, we think ultimately that could shave about 5% off of the level of Canadian GDP and could add as much as 4% to the Canadian price level. I should add that in all these cases, they do somewhat subtract a little bit from US growth and add a little bit to US inflation. But the reality is US trade with Canada and Mexico, while it's important, it's just not nearly as big a share of the US economy as US trade is with Canada and US trade is with Mexico. So, and that's what really makes these negotiations to some extent asymmetric. The US really does hold a lot more of the cards, to use the president's words. But we do think all these scenarios are slightly negative for US growth and US inflation as well. And just to pick one example, the no special treatment, the middle scenario, we would see it shaving US growth by 0.4% and adding to US inflation by 0.4%. It's not a lot, but it's, both are mildly negative outcomes for the US economy, and, not the best case scenario. When the best case scenario, I would still assert, would be going back to where we were a year ago.
Yeah, that certainly sets high stakes for the upcoming negotiations. You noted in the report that there are those certain interests in the US, certain industries and certain states that would have more at stake in these negotiations. Does that factor into the likelihood that you've attributed to the various scenarios?
So overall, yes, it's true. Tariffs and the trade uncertainty have added a little bit to inflation and have subtracted a little bit from US growth. But I would have to say the bottom line is the net impact hasn't been as serious as many had been concerned about. And that's one of the reasons why equity markets have just marched ahead and are at record highs in recent days and weeks. I think when we look at which states are most driven by sales to Canada or even imports from Canada, it's really no surprise. It's basically the Midwest and the northern states. I would rank Michigan and North Dakota as it were, right at the top of that list as to who's most dependent. But when you go down the list of the states that are most affected and most driven by Canadian trade, it's exactly the ones you would expect. Basically the Indianas, the Iowas, the Wisconsins, the Minnesotas, following Michigan and North Dakota. On the flip side, it's pretty clear who's most affected by trade with Mexico. It's Texas and New Mexico. They are very dependent on trade with Mexico. If we combine them all together, it's Michigan. That's by far and away at the top of the heap, followed closely by North Dakota. One state that I would point to that's quite dependent on trade, that's in the middle of the country, that doesn't land on the border is Kentucky. And it's not just because of bourbon. It's because of a number of different goods that Kentucky exports to both Canada and Mexico. But really, they're not quite as heavily impacted by trade. So if you think of what really the end game of a lot of these tariff policies by the administration have been, ultimately, I think one of the main goals was to bring back manufacturing activity to the U.S. I think it's way too early to make any determination whether it's been successful on that front. But what we have seen since the start of the year, at least according to the official data, is we've actually seen the number of factory jobs in the U.S. decline. Not heavily. There's nothing, particularly concerning about it, but We haven't seen an increase in manufacturing employment so far, but as I said, it's very early days. I have to say the one thing, if I were to point to anything that the US has gained from it, it's tariff revenue. In the latest month that we have available, the US pulled in almost $30 billion of taxes on customs duties. If you annualize that over a year and it grows a little bit, we're talking about $400 billion. And some have suggested that it might even be a bit above that ultimately. And some have suggested that, and I think it's reasonable to almost think of some of these tariffs more as a fiscal policy than trade policy.
And in the three scenarios, what's your outlook for the Canadian dollar?
I would almost say that it becomes a little bit tougher for the Canadian dollar as you step down. Our view is that in the most extreme case of a divide, you could have the currency drop by about 10%, we think, from current levels. It wouldn't necessarily happen all at once, but we had a taste of that earlier this year when the very initial 25% tariffs were slated to go into place in early February. We saw the currency really swoon to its lowest level in 20 years. We could see it, as I said, dropping by about 10%, which would bring it into the low 60s or a little bit above 150.
The other part of the report that I really found interesting was that there are actually areas, despite all of these trade headwinds that we've been talking about up to now, but areas for potential greater collaboration between the US and Canada. And maybe you could talk to us about what some of those areas are from an economic perspective and how those areas could help businesses that are operating on either side of the border.
Yeah, and I think there's two general areas where I would like to express a little bit of optimism here. One is, before we get into some of those areas for further collaboration, even if we do land on something close to the status quo, I would just reiterate that that does leave Canada and Mexico somewhat favorably positioned versus the rest of the world, versus some of our overseas competitors. And, while it's a small win, it, ultimately, I think would put some sectors, even some manufacturing sectors that are not the directly affected sectors that I spoke about earlier, in a relatively favorable position. So I think that is important. Looking more broadly on the other part of your question, this is something that Prime Minister Carney was pushing for earlier this year. Was the so-called grand bargain or a much bigger deal? I have to say, I note that the Prime Minister has not been talking about that quite as much recently. It seems like the prospects for a so-called grand deal have been have been whittled away a little bit. There's a little less prospect for that. But some areas of collaboration we could still work on, besides trying to unwind some of the tariffs that barriers that have been built up over the last 6 months or so, would be on labor mobility. I still think there is some room for collaboration there. There's definitely room for collaboration on reducing cross-border barriers on investment. Canada is, and perhaps with some justification, Canada does arguably have some of the higher barriers there for foreign direct investment than among OECD economies. And, I do think there is some potential there for improvement. Even on things like intellectual property rights, I think there's also some room for collaboration. I have to say, in the current environment, that's going to be difficult. But I think if we can reach some kind of understanding on a lot of the long-standing trade irritants between the two countries, and yes, there I think of softwood lumber and even supply management, there may be a case or a narrow window for the U.S. to work on some of those other issues with Canada.
Well, there's certainly going to be a lot to keep you and your team busy between now and July 2026, because there's lots to be worked out still. So maybe with that, I'll just close. I just want to say again, I found the scenario analysis is a really great way to allow investors and business leaders and owners to assess their own preparedness against a range of outcomes, because as you said, there really are a range of outcomes. We're really excited to be unveiling this report at the US-Canada Summit, which is a really important forum hosted by BMO and the Eurasia Group for dialogue, policy shaping, and aligning cross-border interests between the two countries. It's reassuring to know that during these uncertain times, there are some opportunities in US and Canadian markets for our clients to continue to prosper. If you'd like to dive deeper, the full report is available at bmocm.com. And Doug, once again, thanks so much for joining us today. And thanks to your team for this really insightful report.
Well, thanks for having me. It was a pleasure.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.